Good morning and welcome to the Bulls, Bears, and the Bell Morning Edition. Thank you for joining us. It is Thursday, November 6th, 2025. Today we're diving into a market that feels, well, pretty tense. We're seeing intense anxiety, some really volatile stock moves, and this huge split between how the US and Europe are performing.
That anxiety is definitely the word for it, especially stateside. You've got this kind of paralysis setting in ahead of the NFP report tomorrow, that big jobs number. And on top of that, we're digesting some, frankly, brutal reactions to tech earnings from last night. The main theme, there's just zero room for error out there.
Okay, let's try to break that down. We see three big things really shaping the market today. First, what you're calling the guidance trap hitting US tech.
That's right. Any hint of uncertainty in the outlook is getting hammered severely.
Second, a major macro event today, the Bank of England decision at noon GMT.
Yep, the Bayboe is walking a tightrope. Inflation's cooled a bit, but there's fiscal stuff coming from the government soon, too. Their wording today is huge for European markets.
And third, casting a shadow over everything, is that anxiety about tomorrow's U.S. jobs report, the NFP.
Absolutely. That NFP data is so critical for what the Fed does next that big money is mostly sitting on the sidelines. Keeps things quiet overall, but makes those individual stock moves even bigger.
So a cautious, jumpy, and really split market. Let's start with that global divide, because the difference between the U.S. and Europe is pretty striking right now.
It really is stark this morning. Over in the U.S., futures for the S&P 500 and NASDAQ 100 are, well, they're being described as little changed, subdued, basically treading water. They bounced back a bit midweek, but there's no real conviction. The big worry hanging over everything is just lofty tech valuations.
People looking at those high PE ratios and getting nervous, right?
Yeah.
Especially with rates where they are.
Exactly. You see stocks trading at 30, 40, 50 times forward earnings, and you think, how much higher can they really go if borrowing costs stay high? It breeds caution.
Okay, so that's the fragile U.S. picture. But then you look across the pond to Europe.
And it's a completely different story. Real relative strength there. The UK's FTSE 100 is flirting with record highs again. And maybe even more significantly, the German DAX forecast is explicitly bullish. Analysts are saying it's finally breaking out of that consolidation phase it's been stuck in for months.
So why the split? What's driving Europe's strength?
It really comes down to fundamentals versus sort of forward-looking fear. The U.S. is stuck on anxiety about the future, about guidance. Europe, on the other hand, is rallying on actual positive, hard data.
Okay, hard data. Like what specifically? This is important if we're talking about money potentially moving.
Right. We're talking about better than expected numbers people can actually see. Services PMI data, the pulse of the modern economy, came in strong for Germany, Spain, Italy, and on the industrial side, too. German factory orders were solid. French industrial production beat expectations. It suggests the European engine is actually picking up steam.
So Europe has proof, actual numbers showing things are getting better. That's boosting the DAX. Meanwhile, the U.S. is bogged down by sentiment, valuation worries.
And those fears are getting validated by the sharp earnings reactions we'll get into.
So the implication for listeners, for investors, this could be a real capital rotation playing out. Money moving from potentially overvalued U.S. tech to Europe, where there's data backing the rally.
It certainly looks like it could be. Allocators might be thinking, why sit in expensive U.S. tech that gets punished for the tiniest miss when there's accelerating growth in Europe backed by data and arguably at lower valuations? It's a move towards maybe a bit more certainty.
But is it just a temporary hedge before the NFP? If that number comes in weak tomorrow, doesn't everyone just pile back into U.S. growth?
That's the billion-dollar question, isn't it? Yes, a weak NFP could definitely reignite the U.S. growth trade, but, and this is the key difference now, the European data is improving fundamentally. If Germany keeps posting strong orders, if services across the continent keep accelerating, then that European rally starts to feed itself. It becomes about actual earnings growth, not just Fed hopes.
So Europe could potentially decouple. Its performance might stand on its own legs, even if the Fed pivots.
Potentially. It's the first time in a while we can even suggest that with some confidence based on the data. It's not just about dodging NFP risk. It might be about finding genuine, accelerating value overseas.
Okay, let's dive into that U.S. tech pain you mentioned, this guidance trap. Explain what that means exactly.
It's this dynamic where good Q3 results, they just don't matter much right now. The market is laser focused on the future, and it's punishing, really punishing any uncertainty, any slight miss in forward guidance, especially for these high growth, high valuation stocks. There's just no margin for error.
Fortinet FTNT seems like the poster child for this.
Absolutely. A perfect painful example. Their Q3 numbers were actually good. They beat earnings estimates 74 cents versus 63 expected.
Okay.
Revenue beat $1.72 billion versus 1.7 they're $1 billion. Operationally, solid.
Yet the stock is getting crushed pre-market, down what, 9 or 10%? Why?
Solely because of guidance. Their Q4 revenue forecast, the midpoint was $1.855 billion. Wall Street wanted $1.875 billion.
Wait, that's a difference of just $20 million on almost $2 billion?
Exactly. It's tiny. You'd think it's a rounding error. But in this market, that tiny miss gets interpreted as a major red flag, and boom, 10% off the stock price.
That reaction seems disproportionate. What does it signal?
Two things, really. One, it shows how sensitive these high valuations are. Even a tiny wobble in future expectations has a huge impact on the present value. And two, maybe more importantly, analysts are taking Fortinet's slight caution and blowing it up into a signal about the entire cybersecurity sector. They see it as proof that enterprise IT spending is slowing down overall.
So the stock isn't just falling on its own outlook, but on the market's fear about the whole industry.
Precisely. It's an extrapolation of fear triggered by a minuscule guidance miss.
Okay, let's look at DoorDash, DASH, another big pre-market loser, down almost 10%. Different reason, though.
Similar theme, different flavor. DoorDash's core business actually looked pretty good. Gross order value beat their own forecast. Revenue was strong. But they missed profit estimates for Q3. And the real kicker was management talking about an aggressive plan to invest several $100 million more in 2026.
Investing in things like AI, new software. Sounds like long-term growth initiatives.
It does, but the market's reaction was swift and brutal, down 10%. The message is crystal clear. Forget 2026. We want profits now. Stop spending.
Why such a harsh reaction to investment? Isn't that what growth companies do?
Normally, yes. But not in a high interest rate world. Think about how stocks are valued discounted cash flows. When interest rates, the discount rate, are high, money earned far out in the future, like profits from investments paying off in 2026, is worth much, much less today. The market isn't saying AI is bad. It's saying, mathematically, we can't afford for you to spend that money now when the cost of capital is so high and the payoff is so far away. It demands near-term profitability.
It's not all bad news, though. Some companies are getting it right. AppLovin, APP, is up strongly pre-market, about 7%. What do they do differently?
AppLovin delivered exactly what the market wants, a clean beat, hitting numbers on both revenue and earnings. And crucially, they gave a clear, credible story about future growth. They tied it specifically to their AXON 2.0 platform, this new e-commerce portal, things analysts could understand and model immediately.
And the reward was?
Immediate analyst love. Price target upgrades across the board, we saw numbers like $705, $720, even $860 reiterated. It shows the market will pay for growth, but only if the execution is perfect and the story is rock solid, with no whiff of uncertain spending.
All right, let's shift gears to the big macro events influencing everything. First up, the Bank of England decision coming up at 12:00 GMT. You said they're walking a tightrope.
They really are. It's a tough spot for Governor Bailey and the committee. On one side, you've got recent inflation data that came in a bit softer than expected. CPI at 3.8% when folks expected 4.0%. That usually opens the door for a rate cut.
But there's a complication from the government side.
Exactly. The UK government has a budget announcement on November 26th, and the word is they're likely to announce tax rises, fiscal tightening. So if the BOE cuts rates now, just before the government potentially tightens the fiscal screws, it gets messy. They might have to reverse course quickly.
So what's the market betting on? What's the expected outcome?
The strong consensus is for what's called a dovish hold, meaning they keep rates steady at 4.000% today. But, and this is key, they use the statement, the minutes, the language to strongly hint that a rate cut in December is now more likely. Basically, trying to soothe markets without actually cutting yet, giving them time to see the budget details.
Okay, so that dovish hold is baked into the FTSE rally we're seeing.
Largely, yes, which sets up the risk.
What's the risk then, if they do exactly what's expected?
If they deliver the dovish hold, the market might just shrug, maybe a small relief pop in the FTSE. The real risk, the asymmetric move, is if they deliver a hawkish disappointment, meaning they hold rates but give no strong signal about a December cut. Maybe they sound more worried about underlying inflation or that fiscal outlook.
And that would cause
a sharp reversal. The FTSE 100 would likely sell off hard as those dovish bets unwind. And the British pound, GDP, would probably rally sharply as the market pushes back expectations for rate cuts.
While London waits for the BOE, The U.S. market seems frozen by the NFP report tomorrow. You called it the final boss.
It really feels like that today. Institutional money is just fixated on tomorrow's U.S. jobs data. You get the big three: non-farm payrolls number itself, average hourly earnings wage growth, and the unemployment rate. It's the single most important snapshot of the U.S. labor market, and therefore the key input for the Federal Reserve's next move.
And we're in that weird bad news is good news phase right now. Explain that again. Why does the market cheer weak job data?
It's all about the Fed. Strong job growth, and especially strong wage growth, average hourly earnings, tells the Fed they need to keep interest rates high to fight inflation. High rates are bad for stocks, especially growth stocks. So, any sign the labor market is cracking, like we saw earlier this week with news of job cuts hitting a high, is seen as good news for markets. It means the Fed might be able to ease off the brakes sooner.
So bad economic news equals hope for lower rates, which equals stock market rally.
In this specific context, yes. You saw treasuries rally, yields fell on that job cuts news. Traders immediately increased bets on Fed rate cuts next year.
And this anxiety is why U.S. markets are so subdued today. Big players are just waiting.
Exactly. Nobody wants to make big bullish bets today just in case tomorrow's NFP number comes in really strong. That would be a major blow, potentially wiping out rate cut hopes and hitting those tech valuations hard. They're hoping for weakness tomorrow.
Since the big indexes are kind of stuck waiting, the real action, the volatility, is individual stocks reacting to earnings. Let's look at a few interesting ones. Qualcomm, QCOM.
Right. QCOM is a fascinating one this morning. Stocks down maybe 2.7% to 3% pre-market. But here's the thing. Operationally, they beat expectations and raised their guidance. Looks like a classic beat and raise.
So why the drop? I see a headline about a massive loss, $2.89 per share. That sounds pretty bad.
It sounds bad, but it's misleading. That's a GAAP number, generally accepted accounting principles. The actual operations selling chips look really strong. Revenue beat, adjusted EPS beat, guidance beat. The GAAP loss was massively distorted by a huge one-off non-cash tax charge, something like $5.7 billion.
Non-cash, meaning money didn't actually leave the bank. It's an accounting entry.
Exactly. It relates to how they value deferred tax assets, things related to overseas earnings. It doesn't impact their current operations or cash flow. It's accounting noise.
So the algorithms or headline readers see the big negative GAAP number and sell.
That's likely what's happening. Automated trading sees the loss, hits sell. But investors who dig into the details see the strong underlying business and the good guidance.
Creates a potential inefficiency. A buy the dip chance for those who see past the noise.
It often does. The noise is temporary, the fundamentals look solid, maybe even improving. That discrepancy can be an opportunity.
Okay, contrast that with Albemarle, ALB, the lithium producer. It's one of the top gainers pre-market, up over 3.5%. But they reported a big net loss. How does that work?
This is a classic better than feared situation. The whole lithium sector has been absolutely hammered. Prices down, oversupply worries. Albemarle stock itself fell over 8% just yesterday going into the earnings.
So expectations were incredibly low. People were braced for disaster.
Completely. So when they reported, yes, it was a net loss on a GAAP basis, $160.7 million. But they managed to beat the very low revenue estimates, and importantly, they still generated positive adjusted EBITDA earnings before interest, taxes, depreciation, and amortization of about $225 million.
So not great, but not the total catastrophe the market had priced in.
Exactly. The stock gain isn't because the quarter was good. It's a relief rally. Shorts covering, extreme fear unwinding. It was simply better than feared.
Now, the big one today, Tesla. TSLA, gaining a bit, 1-2% ahead of the annual shareholder meeting. What's the focus there?
It's not about Q3 numbers today. It's all about corporate governance, specifically the shareholder vote on Elon Musk's huge pay package.
The multi-billion-dollar one. What are the odds looking like?
Prediction markets are showing very high probability of it passing, like over 90%. Big institutional shareholders have already said they'll vote yes.
So the yes vote is mostly priced in. Small rally today reflects that expectation.
Seems like it. If it passes, maybe a little sigh of relief, but probably not a huge move up. The real story here is the asymmetric risk.
Meaning the downside risk if something unexpected happens.
Exactly. The small but non-zero chance that shareholders vote no, that would be a shockwave, a massive vote of no confidence.
What would a no vote trigger?
A huge sell-off, almost certainly. The market would immediately have to question the Musk premium built into the stock price, the idea that his leadership justifies a valuation far beyond a normal car company. A no vote would raise fundamental questions about his future, the company's direction. It could shatter the investment case for many. The downside is potentially much bigger than the option market seems to be pricing.
Okay, one more interesting situation. The One Group Hospitality, STKS, they report after the close. Expected loss per share, but you said the numbers don't really matter.
Not today, no. This story is all about an activist investor, Randian Capital, turning up the heat. They've made very specific, very aggressive demands today, right before the earnings call.
What are they demanding?
Basically, a complete overhaul. Stop spending company money building new restaurants, switch to a franchise model where others pay them to open stores, and hire bankers to look at selling off brands like STK or Beniha to cut debt.
Wow, that's forcing management's hand right before the call.
Absolutely. So the Q3 numbers are irrelevant background noise. The only thing traders care about is how CEO Emmanuel Hilario responds to those demands on the conference call later today, around 4:3 p.m. Eastern.
A binary outcome then. If he signals openness to Randian's ideas, the stock could jump. If he resists, it falls further.
That's the setup. Any hint of moving towards a franchise model or selling assets could pop the stock, as the market likes those asset-light models. But if he digs in his heels, expect a fight, and likely more pressure on the stock price. It's all about the call tonight. #tag outro.
So wrapping things up for today, it really feels like we're dealing with three different markets at once, a trifurcated market.
Yeah, you've got the macro market totally focused on the BOE today and NFP tomorrow, keeping the big indexes sort of pinned down.
Then you have the U.S. tech market caught in that guidance trap, super sensitive to any forward-looking wobble.
And finally, the European and cyclical market, which seems to be actually moving on positive fundamental data, maybe starting its own path.
The key takeaway seems to be that NFP report tomorrow is the main event hanging over everything. That anxiety is capping broad market gains today.
Forcing investors to really focus on these individual stock stories, the potential opportunity in QCM's accounting noise, the warning from FTNT's guidance punishment, and the high-stakes drama around Tesla's vote.
So a final thought for everyone navigating today. If the Bank of England delivers that expected dovish hold, does it just kick the can down the road, pushing the anxiety onto their December meeting?
Or is the strength we're seeing in European data real enough? Could the EU rally actually start to decouple from this intense U.S. focus on NFP and Fed policy? Something to definitely ponder.
Definitely something to watch. We'll be back tomorrow, of course, to break down that crucial NFP report and see how the market reacts. Thanks for joining us for this deep dive.